Oh, hello YouTube, hello YouTube. Okay, so today's video is called the cognitive process of investment. So I think I wanted to do this video because when I'm speaking to my friends and family, lots of people are considering investing at the moment, mainly because there's currently an economic recession and stock prices have dropped. Basically meaning that if you invest now, there's a possibility that the stock prices increase again and you're able to make a return on your investments. But lots of people aren't investing or are kind of scared about investing fuel because generally they don't know how to start or they don't understand the basic concept of what to consider when you're investing. So today's video is just kind of introduce people to the idea of investing. And I think the reason why quite a lot of time people are so scared about investing is because they think that investing is so complicated, and mainly because there's loads of acronyms in investing, which generally people don't know what they are, and also because when you think about investing, you think you have to be good at math, maybe you have to be like finance, you think bankers with like ties and suits and everything. It sounds all very professional, sounds really complicated, but actually it's really easy. And when you look at all the materials and read loads of books and you listen to people on YouTube or whatever who have succeeded in investing, like a good example of the person is Warren Buffett. Quite a lot of the points I'm covering today kind of come from his school of thought. You realise it's actually pretty simple. And I've essentially got 4 of the main points you need to be considering when you're thinking about investing, and it kind of gives you an idea of the strategy to take when you're investing and what to invest in. Okay, so the first 2 points I want to cover is essentially just giving you an understanding of what to think about when you're about to invest. The third point is essentially like a strategy in investment, and the fourth point is it helps you decide what companies you're going to invest in. Okay, so the first point is investing is always a risk. Now you always have to understand that. So there's no stock, there's no asset where if you invest in, you're definitely going to make money. If someone tells you that there's an investment strategy which always works, or if there's an asset which is always going to lead to profit, it's a lie. Okay. And it's really easy to run rings around them if they do say like investment strategy always works, for example. But it's like if you're telling me if you're selling me a book which says this investment strategy always works, it's like, why are you selling the book? Why do you need to make money by selling a book? Because you can just invest yourself. If this investment strategy or this stock is always going to give you profits, then you just do it yourself, wouldn't you? The fact that they're not doing that means something like that doesn't exist. Okay. So it's important that bear that in mind. And if you think you're going to go into start trading in stocks and you think you're always going to make a profit and you're never going to make a loss, you're going to have a really bad time. But that's never going to be the case. Everybody always makes a loss if you're doing some kind of trade. Second thing, though, to consider is that cash is a risk. So I think this is something which people don't necessarily understand. So normally people go and they work, right? And then they get given cash in hand, or let's say, and maybe they just keep it at home, or it gets maybe automatically transferred to the bank. But you're essentially investing in cash. That's what it is, okay? If you're holding money in cash, you're investing in cash. Think of it that way. And I want you to realise that that's actually also, holding that cash is also a risk as well. So let's consider the US dollar to the GBP exchange rate, for example, okay? So at the start of the year, the US dollar would buy you around 76 pence. In the start of 2020, but currently the US dollar buys you around 81 pence to the GBP, to the Great British Pound. So what does that mean? It essentially means at the start of the year, if you had $1, you were able to buy only 76 pence of GBP, but now you can actually buy, only 4 months later, you can actually buy 80 pence. Which essentially means the value of the GBP has declined and the value of the US dollar has appreciated. So if you're living in the UK like me, and you hold a GBP in your account, what does it mean? It essentially means you've lost 6.6% of the value of the money you hold. So you can see that's a risk. So, and actually, when you think about a decline of 6.6% in the money of the assets you have in just 4 months, not even a year, that's huge. I mean, if that continues over the whole year, I mean, highly unlikely that it will, but let's say that continues for the whole year, that's essentially an 80% decrease in your investment, which is ridiculous. I mean, there's plenty more safer assets like government bonds than that. So that's the point I want you to consider. So obviously, when you invest money in stocks and things, or different assets, that's obviously a risk as well. But at the same time, holding cash just by itself is also a risk. So you kind of never ever away for risk, if you will. So don't let the fact that investing in a stock is a potential risk make you shy away from investing in stocks. third policy. So third point I want to go over. So this is essentially the strategy of investing. So I think generally when people think about investing or they want to invest, they generally see some kind of news article which says like this industry is going up, or maybe this stock is going up or something, and then they think, oh my god, this stock is going up, oh my god, if I invest now the price is going to increase, I'm going to be able to make loads of profit. But actually that's a really bad strategy, because essentially what happens in investing is that, let's say everybody, when it's on the news that the price of a stock is increasing, everybody else in the market has already seen that news. Okay, so what happens is that at that point, when it's for all that information is for everybody to see, everybody's already started investing and the price has already started increasing. So then if you want to try and invest, then what happens is you're kind of just going on the back belt of when the price has already gone from down to high. So your best bet is that the price increases for a bit further, it keeps on increasing a bit further, and that way you can make a tiny bit of profit. But there's also the risk that it might go down again, because at the point that everybody's kind of realised that the stock should be valued higher and the price has increased, the value is already high. So kind of investing in that stock isn't really going to get you that much benefit. So essentially, the rule can come down to don't follow what everybody else does. Think about what you want to invest yourself. So if you're going to do an investment in a stock, you look at a stock and you think, all right, I like the look of that stock, hence I'm going to invest it. I don't care what everybody else is saying. I'm investing in that stock because I've got my reasons for investing in it, and that's when you can really make a profit. So let's say everybody else is thinking like this stock is going to do really badly, and you think it's going to do really well. If everybody thinks it's bad, the price is low, but you buy it, you think it's going to go up, and let's say it does go up. That's when you really make the profit. And that's the kind of strategy which Warren Buffett has done in the past as well. And, you know, he's like the fourth richest person in the world, and he's like literally considered to be like the most successful investor for like all time. So the last point I'd like to go through is essentially then kind of like the formula or the variable to look at to think about what stock you're going to invest in. Because, you know, it's all very well saying, all right, so don't follow what everybody else does. But then if you don't follow what everybody else does, you know, how do you decide what to invest in? Like, it's easy to say, if you see a news article which says, I don't know, some kind of companies, Walmart or Tesco, let's say some kind of supermarket stock is going to go up, and then you think, and you look at it that way and you think of this, it's quite easy because you're like, you know, you're being told what to do by the news. But, you know, if you do what I'm telling you and you say, okay, I'm going to go to the opposite of what everybody else is doing, it's like, kind of like, well, but then I don't really know what to invest in. And this is where this helps, okay? So this is a basic formula. It's called the PER. It's a very basic formula of investment, but it's essentially the key one you need to look at. And there's lots of different other formulas like PBR, EBITDA, but essentially you don't need to worry about any of those. So there's all these acronyms, all these different formulas, and they can be useful in certain situations. Like, for example, EBITDA is useful if you own a company, or you have like a direct interest in the company, or you're like a majority shareholder or something. But obviously the majority of us aren't in that position. We're just going to be buying a little tiny proportion of the company. And the important thing to look at in that case is the PER. Okay, so what the PER essentially is the price to earnings ratio. And when you look at the formula, it's a bit difficult to see, but it's essentially the share price divided by the earnings per share. Now, me just kind of throwing that formula at you, it's going to throw you off track, and I don't think it's very helpful. So and let me give a bit of analysis and just kind of explanation of what it means, because actually it's a very, very simple idea. So essentially, PER is the share price. We all know what a share price is, okay? So we know it's just like a share is basically like a proportion of a company, and you know, share price is just the price which is allocated to that proportion of the company. So let's say a company has like 100 shares, for example, right? And let's say the share price is around £2 per share. Then the total company value is around £200, 2 times 100, right? Because they have 100 shares, they've got 100 proportions of the company, each share price is £2, £200, right? So that's essentially what a share price is, and also kind of what the share value in total of a company is. And then we have the earnings per share. Now this is just as simple, okay? So essentially the earnings of company is you could be just considered as a profit. So let's say a company is earning, let's say, £100 profit, right? And let's say the company has 100 shares. Then 100 divided by 100, essentially the earnings per share is £1. So it's just the amount of profit allocated to as one share of a company, which is just a simple formula of profits divided by the number of shares. So this is where I want you to think. So let's say the share price in that example is £2 per share, and the earnings per share is £1 per share. Why is that? Because when you really think about it, when you're investing in a company, what does the company do? The company basically generates profit, right? So why is it that investors are willing to pay £2 per share for a company when they're only earning £1 per share? It just seems strange, because essentially, just considering logically, what's happening is that you're paying £2 for something which is only actually earning you £1. It just doesn't make any sense. So there must be some sort of value being allocated to that share, which is making investors pay 2 times the value of what is actually than the profit is actually generating. That makes sense, doesn't it? And what is that? That's the prospects for the company. It's like the future value of the company, if you will. Because let's say an investor thinks, okay, I'm going to buy this company's share. I'm going to buy that one share for £2. That's the share price. But actually, and also it's only earning a profit of £1 at the moment per share. But it's going to triple in terms of the profits it's going to earn in the future. And I think in a year that the earnings per share, so the total earnings for the company, let's say, is going to be £300 with 100 shares, so it's going to be £3 per share. Then, by investing that £2 and just buying that, with a share price of £2, you're actually making a profit of £1, 3 minus 2. So essentially, what the PER, the price earning ratio, illustrates is something very simple but very, very useful. It's the future earning prospects of the company, and the higher it is, the higher the consideration in the market is for that company's future growth. And that's why you should be looking at that value, that variable, when considering investing in a company, because it essentially illustrates what the current market consideration for the future prospects of the company is. And obviously that's what's going to drive the price of the company. And in general, when you look at Standard & Poor's, for example, Standard & Poor's is very common stock trading, but it's essentially, I think it tends to be around between 13 and 15. I think that's around right. So that's just kind of a general idea of what like the top companies' PER ratios tend to be. Now, this is where I don't want you to make a mistake. Just looking at the PER in itself of a particular company doesn't really mean much. So let's say a company has a PER of, let's say, 5, or let's say 10, or let's say 20. It doesn't really mean anything on its own. What you need to do is compare it to other companies, and this is where you kind of like your personal opinion comes in, and it's also where you the kind of like the third rule applies as well. So let's say you have a company you think is really good, and you've kind of done research on it, and you're really happy about the products that, say, the company produces, and let's say it has a PER of 5, and let's say there's another similar company which you think isn't doing so well but has a PER of 15. What does that mean? It essentially means that the company which has PER of 15, which you don't like, is considered the market in the market to have higher future prospects. So it's considered by the crowd, by like everybody, to have a higher value and future prospects than the company you're interested in, which only has PER of 5. So what it means is that essentially all the money is moving to this other company which has a higher PER, and there's not that much investment. So essentially means your analysis is that the company you're interested in is undervalued, and that's the perfect timing to invest, because essentially everybody's kind of like moved out and all the money's going somewhere else, and your the value of your company is undervalued. And if you invest at that point, and if your consideration is right, in the future your company is going to increase by a higher amount than what is considered by the market, so like than its PER. So you're thinking that the PER for this company should actually be like 20, but it's only 5. So you can actually buy it really cheaply because no one else wants it because the PER is so low. Everybody's thinking this other company with 15 is going to do better. But you're actually saying that this company is going to do even better than that. So by investing in that and kind of beating the market, you're actually making a massive profit because the actual prospects of the company is higher, and actually the share price is likely to increase by much more than what the current market is considering. So I think when you really think about it that way, and you think about all those points I've considered, it's actually very simple. I mean, you only really need to consider one formula. And most of this information is online on Google, Yahoo. If you just search PER for a particular company, type in company names, or you just kind of get a list of companies, you can see all of the ratios, and you can do easy comparison. So it might take a bit of time, but it's really easy to compare. And then when you actually consider all these rules, there's not that many points to consider. I mean, at the end of the day, it comes down to a bit of luck as well. but you're not having to do any really complicated mathematics. It's simple. So I think that's the point I'm just trying to get across. Don't overcomplicate things, and just follow these simple rules. And I suppose another thing I'd like to point out is also to have fun in investing. Okay. Well, anyway, thank you.